Good afternoon, everyone. I hope everyone is ready to tune into this webinar while enjoying their lunch break. First off, I want to introduce myself. My name is Mason Husseini, and I'm the Communications Chair for the CFA Society Ottawa. I'm mostly in charge of preparing our quarterly newsletter and help with improving our online and social media platforms and increasing our presence and contributions. I highly encourage everyone to check our website and LinkedIn page for the latest events and updates. Aside from volunteering with the CFA Society, my full-time job is working as a portfolio analyst for the multi-asset management team at Scotiabank. One of the asset classes that we invest in is, of course, FX, and is in fact, I'm a member of the FX committee itself in our team, which is super relevant to today's topic on currency risk as an investment opportunity. I'm excited to learn more about currency risk and investment opportunities, as this is not only relevant to my current role, but is something that is highly in the spotlight given the current geopolitical developments in the world. We are fortunate to have Dr. Michael Sager join us today. Dr. Sager is a member of the CIBC Client Portfolio Manager team. He partners with all CIBC distribution channels to deliver targeted thought leadership, education, and investment advice and perspective to clients and consultants. Prior to joining CIBC Asset Management in 2018, Michael was an asset allocation consultant at Alignvest Investment Management. Previously, he was a senior portfolio manager at the Canadian Pension Plan Investment Board, a fixed income currency strategist at Wellington Management, head of the currency research at JP Morgan Asset Management and Putnam Investment, and an economist at the European Central Bank and the Bank of England. Michael earned his Ph.D. in economics from the University of Warwick and a Master of Science degree with distinction in economics from the University of London. All I can say is just, wow, this is fantastic background. Just before we get the presentation started, I just wanted to let everyone know that there will be several opportunities for Q&A throughout the session. We highly encourage any and all questions. Once you've typed those into the chat, I'll read them on your behalf. So without further ado, Michael, the floor is yours.
Great, thank you very much. Thanks for the opportunity. Thanks everybody for taking the time. Let me share my screen and so we get to see presentation. And I'm going to maximize it to, all good? Excellent. All right, so currency risk as an investment opportunity is the topic, and I'm going to go fairly quickly through some of the thoughts we have about the relevance of currency from both a strategic perspective in portfolios, but also as an active investment opportunity. How it adds value, how you allocate to it, how you identify investment opportunities, as well as initially the optimal hedge ratio as a completely separate decision. So we'll cover a lot of ground, and as was said, lots of opportunity for questions. This is not meant to be a sales pitch, so it's not going to be a sales pitch. I'll just, for a little bit of context though, for 30 seconds, just give you the context of where I sit within CIBC. I'm a member of CIBC Asset Management, and in that graphic on the right-hand side of the slide here, CIBC Asset Management fits within commercial banking and wealth management. And of course, we have arms in capital markets, in the retail and business banking sector, also a growing presence in the US. Within all of that, and now focusing on the asset management side, we have a significant number of areas of expertise in terms of investment capabilities and solutions we offer to our clients and prospective clients. One of them is our currency capabilities and team. And so that's where I'm going to focus on the conversation today. So that was the background on CIBC. Let's move on with the main part of the presentation. So I think it's important when we think about the role of currency in portfolios to just pause for a little bit before we jump straight into its role as an investment opportunity, because I think there's oftentimes a little bit of confusion about the roles that currency does fulfill in a portfolio. And so let's make sure we're all on the same page. To my mind, there are two roles. One is its strategic hedging role and the decisions that we take around the strategic currency exposure that we want in portfolios as a proactive decision. And then completely separately from that decision, its role as a potential active investment strategy that can offer investors an additional liquid diversifying source of return. So we need to keep those two perspectives on currency very, very separate. So let's spend a few minutes at least just talking about the strategic element, again, to make sure that we understand how we come up with decisions on what an optimal strategic currency hedge looks like, in this case from a Canadian perspective, but from whatever perspective we have as an investor. To us at CIBC Asset Management, deciding upon the strategic currency hedge ratio within a portfolio is one of the key original decisions that a pension plan or any investor who invests in international assets, global assets, it's one of those decisions that needs to be made at the outset of the plan. It's one of the key decisions, along with the other ones, some of the others that I've mentioned. Do we use internal or external managers? Do we use active strategies as well as passive? Do we use derivatives, and so on and so forth? Another key strategic decision is, do we hedge our currency exposure inherited from global investing? And if yes, to what extent do we hedge? So that's a really important decision. Just to make it crystal clear, currency as a strategic hedging decision arises because whenever we invest in global assets, equities, bonds, private equity, infrastructure, it doesn't matter, we get two things. We get the exposure to the local asset, and we inherit exposure to the associated currency. In an overwhelming majority of cases, when an investor makes a global investment allocation, they're thinking about the optimality of that local asset. Let's make it a bit more concrete. Let's say we want to go long or make a strategic allocation to UK equities, for instance. You get two things. You get UK equities exposure, and you get exposure to the pound sterling. The equity you want, the pound you inherit as a necessary consequence of your decision. You're not necessarily a currency specialist, so really don't know what's the expected return on that currency exposure or what you should do about it. That's why it's important to have a strategic currency hedging framework established from day one. Okay, so it's very much an inherited exposure, the strategic currency exposure you get from global investing. So that's important. So then what's the objective of a strategic currency hedge? Well, there's no one answer, there's no right answer. For some investors, we're going to decide the optimal currency hedge ratio to minimize overall portfolio volatility. It might be to match liabilities. It might be to minimize cash flow volatility. All of those different objectives potentially lead you to a very different strategic currency hedging decision, or a different currency hedge ratio. So it's important to understand what it is you're trying to achieve with your currency strategic hedging. What is the optimal hedge ratio? Again, there's no one answer, but it's very clear that the optimal hedge ratio is typically specific to an individual investor, and it should be chosen to be not only consistent with your investment horizon, maybe that's 3 years, 5 years. When I was a PM at the CPP, it was 40 years. Make sure that the investment horizon over which you're choosing the optimal hedge ratio is consistent with your plan's horizon. Use forward-looking macro assumptions, not rear view analysis. Make sure that you're basing your hedge ratio assumptions in terms of, for instance, correlations between currency returns and local asset returns. Make sure they're being based on forward-looking macroeconomic analysis and rather than historical rear view. That's really important. And then we have to decide, do we have a different hedge ratio for each currency, for each asset class, or do we keep things fairly generic? My opinion is that simple is better in most cases, but we certainly have clients who complicate things to some degree, particularly by choosing a different strategic hedge ratio for different asset classes, fixed income versus equity, for instance. But these are all very personal or very specific decisions specific to each investor. There's no right or wrong answer. How often to review the policy? Again, on a horizon that is consistent with your plan's investment horizon. Typically it's 3 or 5 years, but that's not always the case. So again, don't shoehorn somebody else's assumptions into your plan and your decisions about strategic currency hedging. And then I wanted to, a couple of final points, what does success look like for the plan? Again, that will go back to that first set of questions I had. What's the objective? Risk minimization, liability matching, so on and so forth. That's the definition of success. Did you achieve that? And that really plays into what I've highlighted at the bottom of this slide, some of the pitfalls around strategic currency hedging. The first and perhaps the most egregious pitfall is to have no decision on what your currency strategic hedge ratio is for your global investment exposure in the portfolio. Because as the old saying goes, indecision is decision. And so you do have a strategic hedge ratio. You just need to make sure it's one that's proactively decided to be consistent with your investment objectives and goals. So it's important to make a proactive decision. Second pitfall, don't appraise the success or failure of the hedge ratio based on historical returns. Expected returns to inherited currency exposure, which is what we're talking about now, the expected return on average is 0. So appraising your strategic hedge ratio decision on whether it added or subtracted value in a particular period, 1 year, 3 year, makes no sense, because the expected long-term return is 0 to inherited currency exposure. And so that's important. That's not the criteria to appraise success on. And then finally, one of the other big pitfalls that investors fall into is to tactically manage their strategic currency hedge ratio, to suddenly have a moment of clarity, or so it seems, and decide, well, of course, currency X or Y is going to strengthen or weaken, and that means we need to do this or that. That tends never to work. Mixing strategic decisions with tactical decisions is something at CIBC we definitely encourage our clients to avoid. Complete separation of strategic decisions from tactical or active decisions is our advice, and I just wanted to emphasize that. So far we've talked about the first part of the presentation. Hopefully it wasn't too prescriptive. It wasn't intended to. I was trying to provide some pointers and some pitfalls to avoid, but that's the first aspect of currency in portfolios, the inherited exposure from global investments. I want to now pivot to the second part of the portfolio, which is the active investment strategy. Active currency is an investment, active investment strategy. Again, this has nothing to do with the currency exposure you inherit because you invest in global bonds, for instance, or global equity. Completely separate. It's another source of opportunistic investment alpha, shall we say. Okay, so let me talk for a few moments about why an allocation to active currency as a source of tactical risk in portfolios may make sense. Three ideas here. The first one is investment challenges. Whether we look in public markets, equities and bonds and so on, whether we look in private markets, valuations look relatively challenged. So expected returns to traditional and alternative private assets look increasingly less attractive than they have done for a number of years. And that suggests, therefore, that expected returns over the next, for instance, 10 years will be less positive than they have been on average for the last 10 years. So we need to try and find alternative sources of return, differentiating sources of return that can boost the overall expected portfolio performance in the aggregate level. When you look at a lot of traditional portfolios, they also tend to have fairly concentrated risks. Think about equity risk. You know, we can invest in Canadian equities, we can invest in US, we can invest in European equities, for example. In the end, it is equity, and you have equity risk and a high correlation between the returns to those different flavors of public equity. A lot of allocations in pension plans have gone into private equity. But there again, the key word is equity. The underlying source of the cash flow is the same as public equity. You might get a boost in terms of expected return through accepting an illiquidity premium, but nonetheless, you've still got broadly the same source of return, equity cash flow. So that means that the portfolio is still relatively concentrated. We need to find sources of return that are very different. And to get to the punchline on this part of the presentation, at least, currency alpha tends to be sourced from top-down macro information, whereas equity alpha tends to come from a bottom-up analysis of individual names, individual firms. So right there, we've got a chance to have a differentiating source of return by including an allocation to active currency alongside, for instance, either public equity, private equity, or the logic is the same for the various segments of fixed income. So find more breadth in the portfolio, more sources of diversifying return. So active currency is an absolute return strategy. How is absolute return designed to help? Well, by offering a different source of return, we can mitigate drawdowns as well as boosting expected returns on the portfolio. We can hope on average to mitigate drawdowns, and I'll show you some data to that effect, historically at least, in a moment or two. And then let's focus in on active currency specifically, above and beyond those opportunities, the ability to add an extra chunk of expected return, to mitigate drawdowns as well because of the diversification. Active currency is the most liquid investment opportunity out there, T+2 liquidity. So that's important, particularly again, as I mentioned, with the push increasingly into illiquid privates. The need to find at least some liquidity in the portfolio is still important. Active currency is the most liquid alpha opportunity out there. And then the final point on this slide, capital efficiency. For an Canadian investor, active currency is extremely capital efficient because it's typically implemented through forward contracts. That's how we implement active currency for our clients at CIBC Asset Management, which means there's no need for upfront funding. So there's no need to disturb the existing underlying portfolio. You don't have to grab capital from one part of the portfolio to allocate to active currency. The only capital flows that exist are on a quarterly basis for settlement of forwards. If it's a profit, there's an inflow for the client. If there's a drawdown, there's an outflow for the client, but the size of those flows are very limited. And so it's very capital efficient, which makes it, again, a very attractive source of diversifying expected return. So those are some of the key facets of why active currency as a source of diversifying alpha. Just to give a little bit more background as we move forward through the presentation, the bars on the chart here, I've just broken out a number of asset classes, bonds, public equities, just to illustrate my point about the outlook for expected returns. The left hand, or the blue bar for each asset class, shows the annual return over the past 10 years. The right-hand bar, or the orange, for each of the asset classes shows our expected return at CIBC Asset Management for that same asset class over the next 10 years. We always think long term, 10 years ahead. What does the return environment look like? Well, it's more modest. That's what it looks like. And so particularly on the right-hand side of the chart for a global balanced portfolio, the expected return has a 3 handle on an annual basis over the next 10 years, compared to a high 6 for the past 10 years. That's a challenge for pension plans to achieve their return objectives, for foundations to achieve their spending requirements whilst insulating the portfolio from inflation. So we need that additional sources of diversified return. And again, you know, if you think about what that's doing in terms of efficient frontier, as you can see from the chart, compared to 2016, that's the higher, or the gray efficient frontier, the return per unit of risk for different investor profiles. That frontier is being pulled much lower because of those lower expected returns. That 2021 efficient frontier is the lower, or the light blue line on the chart. So we need to move that frontier up and in, more return expectation with ideally less risk, because we're diversifying the sources of return. That's the challenge. The other part of the challenge, though, I mentioned already, traditional portfolios tend to be fairly concentrated in terms of the underlying sources of return. Again, it sounds diversifying to have equities and bonds and private equity and public infrastructure and some REITs, for instance. But when you drill down into everything I've just listed, you've got an awful lot of equity risk. So it's a fairly concentrated portfolio. The challenge is to diversify those sources of risk and sources of return. And the reason you need to do that, or at least think about it, in our opinion, is that the macro environment drives underlying asset returns. And so we've shown 4 different macro environments on this slide. The first bar on the left, growth rising, inflation falling. The next one, growth rising, inflation rising, and so on and so forth. Each one has different implications for asset performance, in this case for a balanced portfolio. You can see on that left bar, that is the highest bar in terms of Sharpe ratio, return per unit of risk, net of cash. As we move away from that macro environment, the performance of that balanced portfolio deteriorates. You can see that the orange bar, that's where, at least when I put this presentation together a couple of weeks ago, that's where we at CIBC expected the macroeconomy to be the next 12 months. It's not a particularly good outcome for a balanced portfolio. In fact, we might well be shifting into the far right bar, which is an even less propitious macro environment for a balanced portfolio. Positive return on average, historically, just not particularly attractive. So can we find other sources of return that not only increase expected performance, but do so on average? So the height of those 4 bars becomes more equal. That's the challenge. So how do we do that? How do we think about that at CIBC in terms of trying to generate insights and alpha from our active currency portfolio decisions? Well, it's very much a 4-stage process. And I'm not going to go through this in detail, happy to follow up afterwards, but I'll just hit some of the high points that we think is really important to put together a very holistic, very well-rounded investment process. At CIBC, we integrate both quantitative analysis, quantitative models, with qualitative analysis too. So quant and qualitative. I know from that list of managers that Mason read out at the start, I know from my previous experience that not just in active currency, but other asset classes too, investment managers tend to focus either on quantitative investing or qualitative judgment. If you've got skill, either one will generate value added for sure, but you'll tend to find that the performance is more lumpy than a process such as ours that combines or integrates quantitative analysis with qualitative judgment, particularly forward-looking qualitative judgment. That integration gives you a much more holistic view of what's driving markets, and therefore tends to be a smoother ride in the long term. So that's important. It's also important, we think, to integrate fundamentals, factors like carry or value or momentum, for instance. Those are traditional fundamental factors. They've proven over decades, not only in currency, but other asset classes too, that they can add value and provide a great quant foundation to an investment process. In addition, though, we think it's important to integrate ES and G risk analysis into investment processes. Think about what's happening in the world today. ESG, of course, is front and center. So it's important in your investment process to not only look at traditional fundamentals, but also integrate ESG risks to make sure that you're introducing, encompassing all relevant risks and opportunities in your portfolio. So that's what we do in our investment decision making at CIBC Asset Management. So that's really all I wanted to emphasize on this slide. Again, it's not a sales pitch, so I'm not going to go deep into the nuts and bolts of our investment process. If you're interested, please feel free to follow up. But one thing I will just dwell on slightly, because encompassing or integrating ESG analysis into a macro top-down investment process is quite rare as we understand it. It's increasingly commonplace for bottom-up equity managers, fixed income managers. For a top-down macro process, it's much newer. It's something that we do. We have a publication, again, happy to share. But the idea, the principle is exactly the same as traditional analysis. You have a set of risk factors. In this case, on the left, I've listed them, ES and G risk factors. We need to be able to map those into measurable data indicators that are coherent across all of the countries and currencies in our investment universe and are readily available, or data is readily available for all of those indicators on a continuous basis. So that's exactly the same process as we take for mapping traditional risk factors like value or carry into measurable data indicators from which we can derive portfolio positioning. We do exactly the same for ESG, and we integrate all of that analysis. So relatively straightforward, but really important to make sure that we are appraising all risks and opportunities in our portfolio. And what that leads to, of course, is just an illustrative example here of a set of longs and shorts short the currencies we don't like, long the currencies that have attractive fundamentals, and with ESG risks that are not an inhibitor to taking those positions. So I won't dwell there. One thing I did want to emphasize about currency, because one of the questions we often get asked is, well, if we think about currency, there aren't many currencies, you know, compare it with the S&P 500. Well, there's 500 equity names to choose from. That's a lot of opportunity in currency, depending upon whether you invest in only DM or, as we do for most of our clients, developed market and emerging market currencies. You may have 34 names, which relative to the S&P is relatively limited. So the question comes, is there sufficient breadth to achieve the diversification I was emphasizing at the start from an active currency portfolio allocation? So here we've taken some analysis from an academic paper by Mucci and others, who are getting a lot of, it's listed in the footnote. Happy to share the presentation afterwards, by the way. It got a lot of airplay, minimum torsion bets. The idea, though, in a nutshell, is to identify how many independent sources of risk and return you have in your portfolio. The more, the better. So what we're showing here with this area chart is since 2007, on a monthly basis, how many independent sources of risk and return have we had in our active currency portfolio. You can see we updated it through to the end of 2021, at which time we had about 9 different positions, 9 different sources of risk and return. That's quite a lot for a portfolio. If you did this same analysis for the S&P, even though there are 500 names, you'd actually find there are only 2, maybe 3 independent sources of risk and return. So 9 is very attractive in terms of investment breadth, diversification, and therefore opportunity to add an accretive source of return to an underlying portfolio. So that's really important. Breadth is always king. So then that leads on to a question about, so, okay, this all sounds good in theory. How have active currency managers performed historically? And so here I'm relying on data from Mercer Consulting, their publicly available database. What we've done here is created 2 tables. The top table is for the universe of active currency managers. And for reference, I've broken out CIBC active currency performance there at the top. The second, the bottom table rather, is for the universe, same source for global active equity managers. And we're comparing median stats over 1, 5, and 10 years, and also the 25th percentile. You can see whichever one of those you care to choose, active currency performance, the alpha has been very impressive compared to global equity. And I think, again, that talks to the sources of risk, the opportunity, the diversification, the breadth. There seems to be historically at least, I should say, there has been accretive information. And I'll talk about the diversification of that in a moment or two. But as a proof statement of the ability to generate return, I think that's quite a strong one. So what does it look like if you allocate to active currency? Remember, this has got nothing to do with the strategic hedging decision in relation to global investment allocations to equity or bond or private equity, whatever it is. What we're now doing is putting active currency on top of your existing portfolio. When you do that, there's no need for the active currency manager to know anything about your portfolio or the allocations. It's a completely separate source of risk and return. So what I've done is just put an overlay of active currency on top of an existing 60-40 balanced portfolio, equity bonds 60-40. That's the lower cumulative return line, the dark line on the left-hand chart. The line on the top, the blue one, is that 60-40 portfolio completely overlain with an allocation to active currency, just to illustrate the difference in cumulative returns, which is quite significant. And then on the table on the right, I wanted to call out, particularly in that blue rectangle, the maximum drawdown of the two portfolios, with and without the active currency overlay. Without the maximum drawdown over that sample since January 2003 is significantly longer. So attractive additional cumulative return, but also shorter and shallower drawdown profile, at least historically. I said I was going to illustrate, excuse me, illustrate the diversification benefit. So we talked about a few slides ago, do active currency managers have a history of skill? And historically, the performance has been positive and more attractive than the global equity managers. We demonstrated that. Is it diversifying? Well, that's what this slide is trying to achieve. What we've put here is a pairwise correlation matrix showing you average correlations over the sample since, I'm just checking before I say it, the data's as at the end of 2021, it's correlation analysis since the beginning of 2003. And so I've got a whole list of equity, bond, alternative asset classes. We've color-coded the matrix. The hotter the red, the higher the correlation. The cooler the blue, the more attractive the correlation, the lower. And you can see I've called out active currency on the right-hand column. There's an awful lot of either very pale red or blues. Active currency historically has been a very diversifying source of return. So accretive as a standalone concept, diversifying within a portfolio. Part of diversification.
If I may ask a question about the last slide, the active currency here, is it a specific basket of currencies? What is in there? What is in that active currency that is showing a very low correlation?
So I've taken the numbers from the CIBC asset management historical performance. So it's for an unconstrained mandate that would include 34 currencies, a mix of developed and emerging markets. All right.
Thank you.
Pleasure. So part of diversification, of course, is the ability to mitigate periods of drawdown for the underlying portfolio. It's all well and good doing well when equities are up 25% like they were last year. But when the rubber hits the road in periods of drawdown, do we have evidence on average, not necessarily every time, that would be a stretch ask, I think. But on average, is there evidence that active currency as an alpha opportunity can mitigate drawdowns? So here I've, and to follow on from the question, here I've taken some generic active currency returns. You can see the Bloomberg ticker I'm using in the footnote. But I've included active currency, the orange bar in the rectangle here, along with some of the other alternative absolute return strategies like managed futures, equity market neutral, for example. And I calculated their average performance in months of biggest drawdowns to equities. So you can see the average largest monthly drawdown per year to equities in my sample is 7% and change. What did those absolute return strategies do during those periods? So absolute return as an opportunity was very diversifying on average, mitigated drawdowns. There's considerable historical evidence in favor of that statement, including for active currency. Okay, so average correlations, low correlations are nice. Ability to mitigate drawdowns is even nicer. Which leads us back to this slide. Including absolute return investments in a portfolio, including active currency, does indeed, in our opinion, based on our CIBC forward-looking expected returns and risk assumptions, does indeed help us push that efficient frontier up and in to improve the outlook for portfolios. So I was just going to finish up with 1 minute more and then hand it back for some more questions if there are any. How do investors typically allocate to active currency? And there are three broad ways. When the active currency industry started, allocations to active currency were traditionally tied to the underlying portfolio. So for instance, for a global equity mandate to include an allocation to active currency, the max min positions that the active currency manager could introduce to the portfolio were limited by the size of the benchmark weight of each equity market. So it would be large for the US, it would be very small for some of the EMs. So that was quite a significant constraint. Those mandates have added value over time. A number of them continue to exist and new ones come along. So it's definitely a good way to augment expected portfolio performance. But it's not as powerful as a standalone allocation to active currency that's unrelated to the underlying exposures. And the reason for that is the unconstrained, unrelated, or untied allocation to active currency is allowed to take more risk, bigger positions, more opportunity. Of course, there are significant risk management guardrails around a portfolio, but there's more leeway to add value, and therefore the end result has been a stronger contribution and a better overall portfolio performance in terms of risk and return. And of course, as well as a standalone allocation to an active currency mandate, another way to do it is to allocate to active currency as part of a broader absolute return investment solution. That could be a, we've highlighted here, a global macro multi-asset strategy. It could be a fixed income strategy that includes a number of enhancements or plus elements, one of which would be global bonds or emerging market bonds. Another would be active currency. So many ways to get exposure to active currency. We've got clients at CIBC Asset Management that pursue all of those different ways. It's a very flexible investment opportunity. It's very scalable. As I said at the start, it's very liquid and it's very capital efficient. And with that, let me pause and hand it back.
Thank you, Michael. That was really insightful presentation. I think I learned a lot, and especially on how active currency can enhance portfolio performance in different market conditions, on which I do have a question. But before that, I will turn to the questions that audience kindly asked. One of our audience has asked, could you give an example? Of course, they have appreciated the presentation first. Could you give an example of how ESG can be integrated in currency analysis, please?
Yeah, 100%. Well, you know, an example from a few months ago, and then I'll bring it right up to date. A few months ago, if you looked at our currency universe and screened it on traditional quantitative metrics, the Turkish lira would have stood out as very, very attractive as an opportunity. It's about 50 to 60% undervalued versus the US dollar using traditional value metrics. It offers a very attractive interest rate carry, at least superficially. And so if you're a quant-only manager, you'd be long the Turkish lira. And of course, you'd have been long and wrong in hindsight. So that leads on to two facets of the way we manage portfolios. First of all, to incorporate forward-looking qualitative judgment to interpret, well, is that carry really as attractive as it looks? Are there other factors that we're not capturing from a straightforward quantitative process that would nonetheless be relevant, other fundamentals? And then are there any ES and G risks? In the case of Turkey, there are a lot of G risks. Governance of the central bank has been completely undermined by the Erdogan government. That means that the credibility of the Turkish lira has also been undermined, and that's why there's such a high interest rate carry. Not because it's a juicy opportunity to invest, but because there's a really significant governance risk associated with Turkish assets, not just the lira. And of course, what we've seen over the last several years is the Turkish lira is not a value opportunity, it's a value trap. And the ES, and in this case, particularly the G analysis, helped us understand that. So then fast forward, of course, to the Ukraine crisis, and you know, I'm going to focus on the economics of it rather than the humanitarian side, which is of course really difficult and getting worse by the day. So I'm going to focus on economics given the focus of this conversation. But again, if you think about the Russian government and its actions, there are, from that list of E, S, and G criteria, a number of reasons why the Russian assets, quite apart from sanctions, would have been derated based on that analysis in a macro context. Now, of course, the ability or desire to own Russian assets has, of course, been eliminated by what's going on in Ukraine. But even if you just abstracted from that and says, what does it do to your ESG risk assessment, then of course that changes too. So those are a couple of examples where that analysis, particularly the Turkish lira one, became very pertinent for our process.
Thank you so much for the answer. I see a couple of other very interesting questions. The other question is that what is the difference between an active currency overlay and making tactical decisions about which currencies will go up and down?
None, if it's being done by a dedicated currency manager. But it's very different if you have a strategic currency hedge on your global equity exposure. you have no particular expertise in currency decision making, and yet you turn up on Friday morning, for instance, and say something in, I've got a feeling that currency X is going to go up or down. Let's make a tactical shift on our strategic hedge. That would be problematic because, one, recall I said that the expected return to inherited currency exposure is 0. So you're now disavowing that statement, but you're doing it without any skill. Whereas, so that's the important difference. If it's a tactical manager doing it, then active currency positioning, tactical currency positioning are one and the same thing. If it's a equity manager doing it, then it's something we would recommend not doing.
Perfect, thank you. The other question has a little bit of cryptocurrency in it. What do you think the deglobalization will impact the currency market, and what is your view on cryptocurrency? How cryptocurrency can be impacting the currency market?
Well, Mason, there's only one question.
This is probably a week-long.
Well, no, it is a week-long answer, but unfortunately, I'm required from a compliance perspective. I'm not allowed to opine on the outlook for cryptocurrency. In terms of its impact on markets, it's a growing investment opportunity, and I think there's definitely analysis out there that's talked about the impact, for example, on the demand for gold, and therefore gold's ability to act as a hedge against inflation volatility. But yeah, I'll do a neat sidestep if I may, and I apologize for the sidestep.
Perfect. So there is also one question. It's kind of my question. Sorry, I'm jumping in the line. So the question is that for the active currency that you mentioned, what is the typical return to risk target that pension plans use? Of course, considering that you said that the graph you showed that in the next 10 years, the returns may be lower across different asset classes. And of course, considering this, what other areas of active return could be pension funds seeking? And of course, these are like two questions, but if you can, you can refer to.
Well, the beauty of active currency is that it's very scalable and it's very customizable to individual investors, individual plans. So you can dial it up or you can dial it down, and it's the same investment process with the same decisions, but more or less expected return and more or less risk. So for instance, at CIBC, we have mandates that run from a risk as low in active currency as 70 basis points a year, all the way up to 1,200 basis points a year. And that implies a return half that size. So we assume an expected information ratio of 0.5. We've outperformed that in the long term, but we're fairly conservative people. So a 0.5 IR. So with a annual risk budget of 70 basis points, that's a return of 35. That's used for a global bond mandate. For a 1,200 basis point risk budget, you'd be looking at 6% expected return. I would say that most pension funds have coalesced around a return target, annual return target of 1 to 2% from active currency. And that's over and above what they're getting from the underlying portfolio. And then they're adding a lot of illiquid asset classes like private equity and unlisted infrastructure, for example. Other absolute return buckets that differentiate from active currency, things like equity market neutral, or bottom-up hedge fund of fund micro strategies are fairly popular. So all of those, broader macro as well, all of those fit together. The way I think about portfolio construction is you've got a rather large jigsaw puzzle, and each of the pieces is complementary to all of the others, or they should be. And so finding those complementary pieces is the challenge to maximizing the probability that you achieve your long-term goals in a way that also generates you quite consistent returns from A to B to C to D and so on, all the way up to Z. Okay, so that's why I think about where active currency fits.
Thank you so much, Michael. There are a few of other very interesting questions, but I deeply apologize. We have run over the 1 hour allotted to us. This is a very interesting topic, and we could go on for like hours. But I'm pretty sure, as you mentioned, the audience can follow up with you, and you were kind enough to mention that this is possible. Absolutely. So I again appreciate the time and the presentation. It was really insightful, and this session is recorded and will be posted on CFA Society Ottawa YouTube channel. And for the future events and to stay updated on the next events that we have, I highly encourage you to search CFA Ottawa. CFA Society Ottawa, even Google it, it will bring up the website, and you can definitely participate in our next events, and we will be really happy to have you. Once again, thank you, Michael, and I hope everyone have a very good day, and I believe that we all need to get back to our full-time jobs. Any last words?
Not for me, just thank you very much for the opportunity. We appreciate it very much.
Thank you, and have a great day.
Bye.
Bye.